$5 million, age 55, can you retire? The math says yes, but $5 million at 55 has to fund something most retirements don't. Nearly 4 decades, 10 years of healthcare before Medicare, and the first 5 years of market returns that quietly determine whether the rest of the plan actually works. I'm Mark Fonville, certified financial planner, and we advise over 550 families across the United States at Covenant Wealth Advisors. Our firm standard for every retirement plan is to target at least an 85% probability your portfolio outlast you. That's not a guaranteed outcome. It's the bar we hold ourselves to. So here's what most people miss. Same $5 million, same balanced portfolio, same retirement plan, 4 completely different retirements, depending on one number you've probably never been asked to pick. Today, I'm walking through a hypothetical case study, a 55-year-old couple, $5 million portfolio, real dollar projections, and I'm going to show you, number 1, what each level of certainty actually costs in lifestyle. Number 2, why 80%, the number most software defaults to, quietly leaves you exposed. And number 3, the 15-year planning window between 55 and 70 that most retirees simply waste. By the end, you'll know exactly which retirement your $5 million is buying and whether it's the one you actually want in the first place. Now, let's dive right into it. Here's why this matters. Retire at 55 and you're not planning for 20 years. You're planning for nearly 4 decades, longer than your entire working career. You'll fund roughly a decade of health insurance before Medicare kicks in at 65. For the couple I'm about to walk you through, that's over $20,000 a year, and it inflates more than 5% annually. And somewhere in those 40 years, at least one bear market is coming. The most recent big one, the Great Recession from November 2007 to February 2009, took about 24% off a 60-40 stock and bond portfolio, like the one we model for Joe and Mary. On $5 million, that's more than $1.2 million gone over about 16 months. So the question isn't whether $5 million is enough. The question is enough to do what? So here's what we're going to cover. First, what probability of success actually means, because if you don't get this part right, none of the rest really matters. Then we'll meet Joe and Mary, a $5 million retirement income plan I built for a hypothetical couple in your similar situation. We'll walk through 3 scenarios at 71%, 80%, and 91% probability of success in actual dollars. Then I'll show you what reaching the 85% probability of success standard we target at Covenant actually costs and why that line is worth it. So stick with me. The number at the end will change how you think about retirement. Now, before we touch a single dollar, let's get this right. When your advisor software runs a type of stress test on your portfolio called Monte Carlo simulation, it tests your plan against thousands of possible market futures. Some good, some bad, and then some absolutely catastrophic. Your probability of success is just a percentage of those simulated paths in which your plan still funds your goals at the end, without you having to cut back, downsize, or go back to work. So 71% probability of success doesn't mean you have a 29% chance of going broke. It means in 29% of the simulated markets we tested, the plan ran short somewhere, and a real human would have to have adjusted the plan to just keep it going. That's the right way to read it. It's the likelihood of retiring with the lifestyle you've assumed without having to change your assumptions. And here's the part that surprises a lot of folks. You don't have to move that number by saving more. Once you've retired, the assets are the assets. The number moves when you change your spending floor. Higher spending, lower probability. Lower spending, higher probability. But the type of spending matters. So when we talk about a 71% versus a 91% scenario in a minute, we're not talking about two different portfolios. Same $5 million, same 60-40 mix, same plan, different spending levels. And that's the dial. Now let's meet the couple. Joe and Mary, both 55, Virginia residents, non-smokers. They're a hypothetical couple and not real clients. But the numbers come from a comprehensive plan I'd run for someone in a similar situation. So here's what they have. A joint Fidelity brokerage account, which is worth $2.8 million. Joe's Fidelity traditional IRA, $1.75 million. And Mary's Fidelity traditional IRA at $450,000 for a total of $5 million. So roughly 56% taxable, 44% tax deferred. So hold on to that mix because it matters in about 10 minutes. Now, here's the portfolio, a balanced 60-40 portfolio that's 60% stocks, 40% bonds, and the long-term assumption on return is around a 5% expected return with normal volatility. The plan runs Joe to age 92, Mary to 94. That's almost 40 years. So Joe files for Social Security at age 70. Combined household Social Security at age 70 is about $90,000 a year in today's dollars across both of them. Now, healthcare. They'll spend about $20,850 a year before Medicare, $25,000 a year on travel for the first decade, and they want to leave a meaningful legacy to their kids. That's the picture. Now, with $5 million, a balanced portfolio, and Social Security waiting at 70, what can they actually spend? Well, the answer, surprisingly, depends on how confident you want to be. Now, here's the version that buys the most lifestyle, a 71% probability of success. Joe and Mary spend $145,000 a year on basic living expenses. That's on top of their $25,000 travel budget and healthcare spending. Across the full plan, that's about $7.12 million in lifetime spending. In an average simulation, the portfolio ends with a safety margin of about $1.59 million in today's dollars. They didn't run out. They left a meaningful legacy. So if you stop there, and a lot of advisors do, the 71% plan looks fine. But here's the part so many people miss. When you stress test the same plan against a bad timing market, and that's markets that drop substantially in the first 2 years of retirement, then vary the rate of return for a period of years following the bad returns to keep the total average the same at approximately 5% across the plan ends with zero safety margin in today's dollars. That means the couple runs out of money at the last possible moment when life ends, right at the line, and quite frankly, a little too close for comfort for most folks. The basic needs still get funded, but only at 90% of the goal. Basic needs include, by the way, their fixed retirement expenses, such as food, shelter, clothing, and healthcare. Their wishes, the things they wanted but only need toward the end of life, such as nursing care, fund at just 22%. Now listen to that again. The 71% scenario in a bad timing market breaks the wish list. So what does 71% actually mean? Well, they live large. The plan works in average markets. And in bad markets, they keep their roof but lose most of what they wanted retirement to feel like in the first place. So that's the floor. Now, watch what happens when we pull the spending back just a little bit. Same $5 million, same portfolio, same plan. Joe and Mary trim basic spending by about $13,000 a year down to $132,000. Mary alone, what she'd spend if Joe goes first, comes in at around $105,600. Lifetime spending falls to $6.6 million, and that small adjustment is what takes us from 71 up to an 80% probability of success. In average markets, the safety margin jumps to about $2.46 million in today's dollars. Again, this is money they would leave to their kids or heirs. And in bad timing markets, the cushion goes from zero all the way to about $343,000. That's not nothing, but it's also not a lot. $343,000 on a $5 million plan, that has to last 37 years. That's about 5% of the original portfolio. A single bad year early on could eat that completely. So here's where the conversation gets interesting. The 80% plan works. All the goals funded at 100% in this run, but the cushion is really quite thin. A lot of advisors will tell you 80% is fine. Some software literally prints the confidence zone target as 70% to 90%. So if your plan says 80%, the dashboard turns green and people just stop thinking about it. Well, I'm asking you to keep thinking about it because 80% is not what we target for our clients. And in a minute, I'll show you exactly why. But first, let me ask you something. If you're watching this with your spouse, go ahead, pause it now. Before I show you the 91% scenario and before I show you the 85, which is the line we draw here at Covenant, I want you to go ahead and do something. Go ahead and pick a number. Don't say it out loud, just decide. Are you a 71, an 80, a 91? Now compare it with your spouse or even with a friend, right? Because here's the thing nobody tells you about retirement planning. It's not a math problem. It's really a values conversation, okay? One of you probably leans toward, we earn this, let's spend it. The other probably leans toward, what if 2008 happens in year one? Both of you are right. The number you each pick says something about how you want to live the next 40 years. The gap between those two numbers is the conversation you've just been quietly avoiding. This video is your excuse to have it. All right, so let's see what 91% buys you and then what 85%, our standard, actually costs from a probability perspective. Now, we go to the other end, the conservative version. Joe and Mary pull basic spending all the way down to $114,000 a year, or $9,500 per month. Mary alone is spending about $91,000 if she becomes a widow. Now, lifetime spending falls to about $5.89 million, the smallest of the three scenarios that we're talking about, and the probability of success climbs to 91%. So the safety margin, $3.75 million in today's dollars on average, the same buying power as about $9.8 million at the end of the plan after 40 years of inflation. But here's the number that matters most in bad timing markets, that 1 in 10 worst case decade scenario. The safety margin is still about $2 million in today's dollars. $2 million in cushion after a bad sequence, with the plan still funding 100% of the goals. So here's where we are. 3 scenarios on the same $5 million portfolio. The 71% plan, $145,000 a year, $7.12 million lifetime, 0 bad timing cushion. The 80% plan, $132,000 a year, $6.6 million in the lifetime, $343,000 cushion. And the 91% plan, $114,000 a year, $5.89 million over the lifetime, and a $2 million cushion. This is the choice. The same money, 3 different retirements. But there's one more column you haven't seen yet, the one we actually target here at Covenant. Look at what happened from 71 to 91% probability. Joe and Mary gave up $1.23 million in lifetime spending. That's the gap between $7.12 million and $5.89 million in lifetime spending. In exchange, they grew their average safety margin by about $2.16 million. And more importantly, they took their bad timing cushion from 0 to $2 million. That's the cost of certainty. There's a trade-off there. In Joe and Mary's case, every dollar of what we call safer cost roughly 57 cents of lifestyle today and bought roughly $1 of legacy tomorrow, plus a downside floor that didn't exist at all in the 71% plan. Here's the uncomfortable truth I want you to sit with. The 71% plan still works in the average case. It doesn't run out. It just doesn't survive the bad decade. And the bad decade is exactly what early retirees just can't predict. Nobody can. So the real question at 55 isn't, will my money last? It's, How much of today am I willing to trade for the confidence that even if 2008 hits in year one, the plan still works? That's the question nobody asks out loud, and it's why the next column really matters. So why 85% probability? Why don't we land our clients at 80 like the software defaults, or push them all the way up to 91 just to be safe? Well, for some folks we do. But here's the math. The 85% plan for Joe and Mary funds basic spending of about $124,000 a year. Mary alone is about $99,000. Total lifetime spend is $6.29 million. The safety margin in average markets is about $3.04 million in today's dollars. And in bad timing markets, $1.18 million. A real cushion, not zero, not 300 grand, over $1 million of downside protection, even if the worst decades hit first. Now, here's the part I want you to remember. The cost of moving from the 71% scenario up to our 85% target is roughly $832,000 in lifetime spending, and only $21,000 a year of basic spending. For $21,000 a year, less than $2,000 a month, Joe and Mary go from a plan with zero bad timing cushion to a plan with $1.18 million in bad timing cushion. That's why we target 85 or better. It's the cleanest trade-off between living your life and protecting your life. Now, if you only remember one thing from this video, just remember that line. The 85% standard isn't conservatism. It's just math and really your comfort level with degree of confidence. Now, I want to take you somewhere, in my opinion, most retirement videos skip past on YouTube. The years from age 55 to age 70. For Joe and Mary, that's 15 years of retirement before Social Security ever turns on. 15 years where the portfolio is doing all the work. Add up their annual outflow during the bridge, basic spending plus healthcare at over $20,000 a year, plus travel, plus taxes, and you're looking at somewhere between $190,000 and $220,000 a year coming out of the portfolio in the earlier years, year after year, with zero Social Security to offset it until later. This is why sequence of returns risk is concentrated in the first decade of retirement. The timing of when bad markets hit matters more than how bad they are. And here's why. When the market drops and you're already withdrawing money to live, you're forced to sell shares at depressed prices just to fund your lifestyle. Those shares are gone. They can't be there to ride the recovery. So a 24% drop in year 25 stings, but the portfolio has time and size to bounce back. A 24% drop in year one, when you're also pulling out $200,000 to live, that's the move that quietly breaks plans 15 years later. And the math is asymmetric. A bad first decade hurts you more than a good first decade helps you. This is why the 71% plan looks fine on paper but breaks in bad timing markets. But there's a flip side to the bridge years that so many people just don't take advantage of, and that is tax planning. So if we look back at Joe and Mary's account mix, $2.8 million taxable, $2.2 million in traditional IRAs. Remember, I mentioned this at the beginning of the video. For 15 years, from age 55 to age 70, they have almost no taxable income. No Social Security, no required distributions. They're spending mostly from the brokerage, which generates capital gains and not a lot of ordinary income. That puts them in some of the lowest tax brackets they may ever see in their lives, which means the bridge years are also what we call a Roth conversion window, 15-year window where they could systematically move dollars out of those traditional IRAs at lower rates before Social Security and required distributions, push their income up into the higher brackets. For a couple in Joe and Mary's situation, depending on tax brackets, conversion size, and how tax law evolves, that window can meaningfully reduce their lifetime tax bill. The bridge years are where the risk lives. They're also where some of the biggest planning opportunities live. Most plans treat them as dead time. We treat them as the most important 15 years of the entire plan. So once you understand the trade-off, how do you actually move your number? There are actually 3 levers that matter critically. Lever 1, dynamic spending. Instead of locking in $145,000 or $114,000 and praying, use guardrails. Spend more when markets are up, tighten modestly when they're down. Done well, dynamic spending is one of the most powerful reasons a plan that prints 71% on paper can actually hold up better than the printed numbers suggest. Lever 2 is Roth conversions. We just talked about this. The bridge years are the cheapest tax window Joe and Mary will ever see. Filing lower brackets during those 15 years can meaningfully reduce lifetime taxes, which has the same effect as adding spending capacity. And lever 3, Social Security strategy. Joe filing at 70 instead of earlier locks in roughly $60,000 a year of inflation-adjusted income for life and a higher survivor benefit if Joe goes first. That's a structural buffer that compounds confidence without touching the portfolio necessarily. These aren't tricks. They're the tools that push your success rate up without giving up the lifestyle, and they're the kind of work you want a planner running for you, not the dashboard on your software. So can you retire at 55 with $5 million? The answer is yes, but now you know the real question underneath. Which retirement are you actually buying in the first place? If you want to see your version of this, your 71, your 80, your 85, your 91% probability with your real numbers, your real tax picture, your real bridge years, that's exactly what we do every day at Covenant Wealth Advisors. You'll see your cost of certainty math for your life, not Joe and Mary's. So just go to covenantwealthadvisors.com and book a strategy session where we'll spend time determining if we're the right fit to help you retire with confidence and peace of mind. And bring your spouse, by the way, if you've got one, because the 71, the 80, the 85, the 91 decision isn't a decision you make alone at 3 a.m. It's the decision you need to make with a professional with real numbers in front of you. So one quick question, by the way, before you go, drop it in the comments. What number did you pick? Was it 71, 80, 85, or 91? I read everyone. The patterns in those answers tell me what to make next in terms of videos. So if you're really thinking about retirement at 55, be sure to watch our video, Retirement is Short, Why Your Biggest Fear in Retirement is Probably Wrong. It'll give you some just powerful tips on spending your money in retirement without all of the math. If this video helped you think differently about retirement at 55, hit subscribe and I'll see you on the next one. Thanks so much.